So children, let us continue the chapter accounting for share capital. Today we are going to discuss about call scenarios. If a shareholder does not pay the call amount due on allotment or on any calls according to the terms, the amount not so received is called calls in arrears. So if a shareholder he is not making the payment on allotment or any calls, the amount which is not received to the company will be termed as calls in arrear. So if in the question it is specified that you are supposed to prepare a calls in arrears account, then you have to prepare this account and show that the amount which is not received to the company by the shareholders under this particular account. Now you can see here there are two methods of accounting of calls in arrears. I hope you understood the term calls in arrears. So you can show it without opening the calls in arrears account. In this case, the problem we can go with an example, that is first call money of ₹2 per share on 10,000 shares is called, but out of this first call money on 9,500 shares is received. So the shares of 10,000 shares is issued, okay, and the first call money is ₹2 which you have to collect. So the first journal entry will be share first call account debited to share capital account. So 10,000 into 2, this is the amount which is due, okay, on first call. So 20,000 is the total amount which the company should receive on the first call. But it is mentioned in the question that the first call money on 9,500 shares is received. So you are receiving in your bank account of the company 9,500 into 2. That makes 19,000. So you are getting, the company is getting 19,000 amount for the first call. So your journal entry will be bank account debited to share first call account. You are supposed to receive 20,000. But you are receiving 19,000. So 1,000 is your calls in arrear. Without opening that account, you have shown the amount of your arrear. So if you are preparing an account for share first call account, that is ledger, so this is the way you have to prepare that account. In your first journal entry, you can see the share first call account is debited. So on the share first call account debit side, you have to write to share capital account 20,000 you have to post over here. And in second journal entry, you can see that share capital first call account is credited. So on the credit side of share first call account, you have to write by bank account 19,000. Then when you close this account, the difference between these two is known as balance carried on, that is a calls in arrear, okay, 1,000. I hope this is clear to you. Now the next case is by opening calls in arrears account. Under this method, unpaid amount is transferred to calls in arrear account. You have to show the unpaid amount in a separate account known as calls in arrear account. So with the same example, you can see here that first journal entry is related to due. That is, you are making the announcement to the shareholders to make the payment for the due amount on first call. So the journal entry is share first call account debited to share capital account. Narrations: being first call money due on 10,000 shares at the rate of ₹2 per share. So 10,000 into 2, 20,000 is the due money on the share first call. Next entry is you have to receive the money. So bank account debited to share first call. But if you remember the question, it is mentioned that you have received the money from 9,500 shareholders. So 9,500 into ₹2, you will get 19,000. That is the amount which you have received on first call. And the amount which is not received will be shown under the account calls in arrear account debited to share first call account. That is, how much shares we have not received? So out of 10,000 shareholders, 9,500 shareholders have paid. We have not received from 500 shareholders. So 500 into 2, that will give you 1,000. So you have not received 1,000 rupees from those shareholders. Okay. A different way of showing the same entry is the first entry will be the same, but this two entry you can show it in a combined way. Instead of going with a two separate entry, you can show it in a combined entry form. That is, bank account debited 19,000, calls in arrears account debited 1,000, to share first call account 20,000. So this is how you have to show the combined entry. The next concept related to this topic is calls in advance. So calls in arrears means unpaid amount, but calls in advance means you have received the money before it went into due. Okay, so a company may, if its article of association allows, accept the money against the call or calls not yet made. So we have not yet made that installment, but some shareholders are making that calls in advance. Okay, so the money amount so received in advance is credited to calls in advance account. Now look at this. Disclosure of calls in advance in the balance sheet. The amount received that is not yet due is a liability on the company. It is shown in the equity and liability part of the balance sheet. Remember children, advance, if you are receiving something in advance, that is your liability. Okay, so that will be shown under the equity and liability part of the balance sheet under the main head current liability and the subhead other current liabilities. The journal entry passed to record calls in advance is, what is the journal entry? Bank account debited to calls in advance account. If you remember the entry for calls in arrears, you may have noted that calls in arrears was debited, but calls in advance should be credited. Okay, so your journal entry goes this way: bank account debited to calls in advance account. Now we are going to discuss oversubscription of share capital. Here you can see that shares are said to be oversubscribed when the shares applied are more than the shares offered for subscription. You have to understand that shares are offered by a company, and who apply it? The shares are applied by the shareholders. When share applied is more than share offered, it is a case of oversubscription of shares. It is a rule that the company cannot allot the shares more than what is offered to the public. So they have three choices available. So company may go with the first alternative, that is rejection of excess application. So whatever is received in excess, that money will be refunded back to the shareholders, and that applications will be rejected. That is known as rejection of application. Suppose here in this example you can see the company is issuing 50,000 shares and they have received 70,000 shares. So we only require 50,000. Excess is 20,000. So some of the shareholders' shares will be rejected. That is 20,000 shares will be rejected and their money will be refunded back to them. Then the second alternative which is available for them is partial or pro rata allotment. Pro means proportionate rate. Okay, in proportion they can allot the share. All applicants are allotted shares in proportion. This is called partial or pro rata allotment. For example, considering the above example, that is above stated example, shares are allotted to all the applicants. We will not, in this case, all the applicants will be considered in the ratio of 5 shares for every 7 share applicants. So we will be going for 5:7 ratio. That is, those who are applied for 7 shares, the company is ready to allot them 5 shares. We will reduce the number of shares which they have applied for. Okay, so that is the second alternative. And there is a combination here. That is, third alternative is any combination of the above two alternatives. So a combination of the above two alternatives may be adopted. Some applicants are accepted in full, some applicants are rejected, and proportionate allotment is made to the remaining. For example, consider the above example. Shares are allotted as follows. Applications for 20,000 shares are accepted in full. Applications for 10,000 shares are rejected, and the balance. So out of that 70,000 which we have received, for 20,000 we have accepted the full, okay, and 10,000 we have rejected, and the balance, so out of 70,000, 10 is rejected, 20 is accepted in full, so remaining 40 will be given on the proportionate basis. That means in ratio of 3 shares for every 4 shares applied. So those who are asking for 4 share, we will not give them the complete share, but we will give them 3 share. In that proportionate way, we will do the problems. So these are the 3 alternatives available. So according to that, you have to go for a journal entry. Now look here, accounting entries in case of oversubscription. So first journal entry will be the same, that is bank account debited to share application account. And the second case, application money for allotment shares, allotted shares. So when you are allotting the shares, the journal entry will be share application account debited to share capital account. Okay, so this is allotment entry, and sometimes you will have to reject some of the share application, and we have to refund them the cash. So the journal entry will be share application account debited to cash account. We are refunding the cash, so cash is moving out of the business. Then if adjustments is there, then you have to move with this enter combined entry. Then the journal entry will be, for all this case, a combined entry can be passed, that is share application account debited to share capital account, to bank account, that is refunded amount, to share allotment account, that is the excess money you can adjust to the next installment, that is share allotment account, to calls in advance account. So these are the entries for oversubscription of shares.